escutando. So, good afternoon, very hot afternoon. I'm very honored to chair this panel talking about Pillar 2 in this brilliant Congress, Brazilian Congress regarding international tax law by the IBDT, duly governed in a fantastic way by Professor Schwery Mairis, who I thank especially the invitation made to be here. I'm honored as in the person of our office as representative of the International Bar, the Brazilian São Paulo Bar Association. So thank you very much. Our panel this afternoon will talk about Pillar 2 regarding a minimal taxation proposed by different economic groups in face of a guidance by OECD, and today has fantastic letters with rare and extremely competent lecturers on the subject at issue here. We have two foreign lecturers, this Professor Kurdu and Andres from Spain and France, that will be here with us, with the colleagues of this table, so Professor Andres Baez and Daniel Gutmann. So we will be addressing this subject together with all in this room, and we will also have an overview, a first mention talk by Professor Cláudia Lúcia Pimentel Martins da Silva, Undersecretary of Taxation and Litigation at the Brazilian Federal Revenue and Master Degree by IBDT. Afterwards, Professor Claudia will do a general landscape of the implementation of Pillar 2 in Brazil. After Professor Claudia, we will have the remarks of Professor Andrés Baez, senior researcher at the Max Planck Institute for Tax Law and Public Finance, and postdoctorate by the Carlos III University in Madrid. Professor Andrés Baez will talk during this panel about the accounting fiscal compliance in the light of Pillar 2. These are the points he's going to address during our panel. Third, we will have Professor Ricardo André Galende Jr., attorney at law, PhD from the University of Cologne, with thesis on the specifically Pillar 2 regarding the subject, and he was awarded the prize of Best Tax Law Thesis in Europe in 2024. And of course, he was honorably mentioned in 2024 by IFA. And this makes it clear to bring here the debates whereupon he will address KDMVT, the minimum tax domestic, regarding everything that was linked to Pillar 2. And four, welcome, Professor. Professor Daniel Gutmann, attorney at law, professor of tax law at University Paris 1 Panthéon Sorbonne, traditional French university and a reference worldwide for all these studies, not only tax law, but also law. And Professor Gutmann will talk about the collateral benefits regarding the context within Pillar 2. And last but not less important, Dra. Soraya Stephens, Executive Director of Transfer Pricing of the Ernst Young in Brazil, Master in International Tax Law by IBDT. And our dear Soraya will be talking about a more practical view regarding challenges faced by Brazilian companies within this context of Pillar 2. And on my side, orchestrating and helping be the important person of this panel, Professor Denise Ferreira Guiotti, attorney at law, accountant, researcher in the University of Economy and Business of Vienna in Austria. So now I pass the floor to Belisa. I stress my thank you and wish you all an excellent panel and wish that we will profit from the debates arising in this topic, which is Pillar 2, which addresses novelties comparing with what in Europe that is already being implemented in Europe, and we hope in Brazil we can reach success with all this. Thank you very much. Now I will come back by the end to my final remarks. Thank you very much. Thank you, Dr. Alessandro. Good afternoon. I'm very honored to be here with you today, lecturing and also moderating this panel with excellent professionals and professors in the tax law and the subject at issue in this panel, and also to talk about the subject which is extremely interesting and it's gaining importance within the global scenario and recently in Brazil. With no further ado, because we are very curious to hear what we have to hear from Pillar 2, and I say this because of the amount of times the subject expression Pillar 2 was mentioned during this Congress, yesterday and today. So to start our panel, I would like to invite Dra. Cláudia Pimental and share with us a landscape on Pillar 2 and especially the stand of Brazil regarding international debates about the subject and a possibly adoption of Pillar 2 measures in the future or close future, probably here in Brazil. So the floor is yours, Dr. Cláudia. So good afternoon. I would like to congratulate the members of this panel table. And of course, I would like to thank IBDT and the person of Professor Schwery, Flávio, for the invitation to be part of this event here and address Pillar 2 subject. I'm happy that Professor Schwery saved me from the table of transfer pricing, which is so complex and the complex debate of previously panels. But Pillar 2 also, those who know it deeply know it's not a simple subject. By the way, all these subjects of international taxation involving a debate with more than 150 countries, you always end by introducing complexity in its enforcement because that agreement must, in a way, accommodate or provide comfort for all the countries involved. So those in the know, in spite of the subject Pillar 2 having an idea that shows a certain simplification, but here if the other lectors ingress in the enforcement, really these rules are not that simple to be enforced. Now, providing the world context and talk a bit about Brazil's context. Pillar 2 is no longer academic debate, a theory debate. Pillar 2 now it's actual. We can see according from OECD data 37 jurisdictions already have rules in place and relevant jurisdictions have adopted European Union and guides countries following the guides of EU, Canada, Japan, Korea, and the outlook is that for 2025 more than 20 jurisdictions will implement it. Therefore, this is a context that truly is being introduced and implemented and of course impacting Brazilian companies. We have that 60% of multinational groups today they are impacted this in 2024 and the outlook is that this number percentage will increase from 60 to 90% in 2025. This especially with the introduction of U2 2PR. It's a rule that it captures in a way undertaxed profit in certain countries that did not implement the Pillar 2 rules. What we have also reassessed worldwide speaking is that there was a reduction of profits that were under tax in 80%. Here also calling your attention, this is OECD data. And the main also that it has an important revenue in terms of the potential regarding collection that might bring to countries regarding Pillar 2 from 155 to 192 billion euros. So this is an assessment that it's substantial, important, that we can see that this you already have in the implementation of Pillar 2 a critical minimum mass that is reaching a huge share of multinational companies. And all these debates, especially regarding Pillar 2, which is a common approach the country can adopt or not, if so, countries must follow the rules that were agreed upon by OECD, so Brazil is not obliged to adopt. If so, it should adopt uh, complying by these rules. We see there was truly the option by many jurisdictions, and it is impacting the trying to guarantee the collection according to Pillar 2, which is the intention to guarantee that entities will pay a tax that is minimum effective tax of 15% in the location where they are acting. Now, as for Brazil, how this is impact? Well, according to our assessment, approximately 3,000 of these groups, multinational groups in the scope within Pillar 2, just call your attention. What's the scope of Pillar 2? It's multinational companies that have invoicing or revenues beyond 750 million euros, which are also, this is the same criteria for the requirement submitting the country report by the statement by country as we call in Brazil. So we have 3,000 multinational companies that operate in Brazil, being that of these 84 are Brazilian groups within the scope. And when we look in terms of the entities, the controlled companies, the entities that operate in Brazil, we have 8,000 entities. As I said, with the adoption of the inclusion rule incorporated by different countries, several countries, UK, Japan, Canada, and European Union, this has already affected Brazilian companies. Therefore, it's a fact today Brazilian companies are affected by it. And according to our studies, this because normally we hear, but Brazil has a tax rate of 34%. Do you think it will be impacted? According to our studies, yes. And there are many entities by reason of tax benefits that are granted, and we will talk a bit about the tax benefits. You have, in fact, when you calculate the tax rate for payment, it is below 15%. Therefore, certainly these companies will are already being impacted in this country, and outside of Brazil we have to collect the difference regarding income inclusion rule. And then we can also talk about our PBU rule, 12973 rule, sets forth a wide rule in terms of scope, and in a way it's similar to the income inclusion rule, but with a bigger scope, because income inclusion rule you capture the profit of your controlled companies or those entities established before below the holding, under the holding, better saying. But you just take up to a taxation of 15%, and we know our rule is wider, and it might reach a taxation of 34% or 25% according to the tax credit which is granted under certain circumstances. So it's a rule which is wider, and then we could address and debate how would be the context of a possible implementation of Pillar 2 in Brazil, and how it would be this relation, if it would require or not a review of our CFC rule. As for implementation, the technical team of the Inland Revenue, they have done the impact study, and we have practically analyzed proposals regarding the implementation of all these rules which are within the scope of Pillar 2. Of course, the main rule, by the way, which is the qualified domestic minimum taxation or tax, it's the primary rule. It's the first that we should be levied in the adoption of Pillar 2. Therefore, what we have in the inland revenue, it's a priority regarding the adoption. If there's a political decision to adopt Pillar 2 in Brazil, it would be GTMT UTT for Brazil will lose these revenues that's being captured in somewhere else. This because the KDMTD is used for those scenarios whereupon you have an effective taxation for the entity in Brazil below 15%. You require to be a collection which is top up tax. You collect the tax difference up to 15%, and with this Brazil will no longer lose, because see, this company will not pay because other countries are implementing. It's just an issue regarding at least the view, the technical team view. You're not tax levy tax here. You're losing tax burden for another country.
So this is the contact in technical terms. So the thing is, doesn't Brazil need that income? Is this the case that according to this reality, because we have seen that important partners that have companies here in Brazil and you do not adopt this? So technically speaking, and what I can say is that we have made calculations and also checked the initial impact of enforcement of of these standards. But in case Brazil decides to adopt the inclusion rule, we certainly will capture, but this will already be covered by several of our CFC rules. So this will be the case for us to assess or to review according to the Pillar 2 uh, landscape, whether this will also be covered by all the CFC rules. Now, speaking of the form, how would it be if this could be covered by a legislation in Brazil? Some countries simply make a reference to Pillar 2, to the OECD standard. It doesn't seem to be the most appropriate situation for Brazil. I didn't realize that the slide was not on the screen. So in terms of the form, this is what we discussed about, the same discussion that we had about transfer pricing. So to what extent we should go into the details in terms of the legislation? And this, based on the discussion that we had in the previous panels, speaking of the principle of legality, So, for example, it's very important that you balance what should be included in the legislation, but also you should also consider if you should not just adopt all the provisions from the guidelines and just reflect that in our statutory law. Maybe part of that could also be regulated by by another legislation. And Pillar 2 affects all developing countries, and then it involves the tax incentives. Those tax incentives that reduce the effective taxation here in Brazil eventually, well, that incentive that was given to the company to remain in the country can not be cannot be not totally beneficial because there is this application of other rules that is applied in the country where the headquarters or where the mother company is located. So this case is very sensitive. And so when we grant any benefit, when the government grants any benefit, all of this should be considered. Now, in the specific situation of the benefit, what do we have? Here we're speaking of those impacted parties that are the ones related to the income tax or CSLL, which are the tax on the income applied here in Brazil. So when we speak about fiscal fees, benefits, and other uh, taxes, this will not be affected by Pillar 2. But with regard to the income benefits, then impact will be bigger with regard to those benefits that have to do with when you reduce taxation on income. Something that will be heavily impacted is PERS. PERS is the one that applies to those entity promoting events, and simply they are not taxed at the source. So this is a benefit that will heavily impact the entity because taxation will occur eventually. So you have to see how you can design that incentive in a way that you do not really lose any taxable income to another country. Now, the other one on the base, especially the ones of temporary services, this is reduced. And there are other elements to remove that impact in order to do not consider that impact caused by Pillar 2. Another important aspect is the benefit that somehow it preserves, and Brazil has adopted, which is the tax credit under the subvention law. This type of incentive is will not be captured under Pillar 2, and the company will not pay, well, will receive the tax credit and can also deduct that in the income tax return, but this will not affect Pillar 2, and there will not be effective taxation in this case. So considering this new landscape in which we have Pillar 2 rules applied, we have to be very careful when doing it. And the IRS has already addressed this in order to deal with the tax incentives. Not on the way to eliminate all of them, because we understand that the benefits are legitimate and they are good for the country and when you want to develop certain areas. But you have to grant them in a way that you don't have that captured in another country because of the Pillar 2. There are rules like the one of a tax credit. All those who have been granted substantially when the company has to acquire tangible assets or pay, this applies to payroll charges because then this can be reduced according to the general rules. So there is not just a migration from an incentive that is given here to be taxable in another country. So thank you.
Muito obrigada, doutora Cláudia Pimentel.
Thank you, Dr. Claudia Pimentel, for this overview. As you said very well, Pillar 2 is a very complex topic. It also involves several issues that are individually relevant and they should be considered by every country adopting Pillar 2. This includes the use as a common base for global taxation, the IFRS accountable rules. And also, they also involve the decision of adopting the minimum cost of Mexico, the entity, which does it goes against some of the constitutional principles. And as you also said, there will be limitations in the capacity of the countries to provide tax incentives in the future because of this. And then the cost of compliance will also increase for companies because the situation will also be more complex, and this will also result in more obligations to the taxpayers. All these issues are very important to be considered and will also be addressed by the other panelists. Now, proceeding with this, I would like to pass the floor to Professor Andres Baez. So he will make an analysis about the compliance of accounting books and tax books in light of Pillar 2. So, Professor Baez, you have the floor.
Can you just show them? Oh, good. Thank you. Thank you very much, Belisa. I would like to start, go back to the beginning. I'd like to start, and it's not really a ritual, thanking Professor Luis Schwery, Luis Flavio Neto, Rodrigo Mato. And I will thank you, of course, for inviting me, which is ritual, and I really feel fortunate, but particularly I will thank you for inviting the other speakers, because the good thing about your Congress, and believe me, I know what I'm talking about. I think this is the 5th time I'm here in your Congress, so I'm kind of regular here or even online in the pandemic. I always heard interesting things, and I really believe that it is very hard for me to find a thing that I have written in the last 10 years that wasn't either inspired by something I heard here, or just something I heard here showed me that I was in the proper road doing interesting stuff. So really, I always hear interesting things. So thank you more for inviting others than for inviting me. But of course, again, thank you very much, pro convite. Not so much, I would think, about the topic, because tax and accounting, global minimum tax and accounting is something I've been doing for a long time. So this is kind of my Liebeskind, as you say in German, so the creature that you love, especially. However, and this is something that Belisa took very seriously in our meetings, you added these challenges for emerging economies. And I'm a civil servant. I take seriously all the orders by the sergeants. So if the sergeant tells me, bring me 5 good soldiers, I go and look for 5 good soldiers. So if you tell me it's about emerging economies, I will not just try and window dress something on emerging economies. I will try and think, especially which are the challenges for emerging economies, which dealing with this topic is not so easy, actually. But I think I discovered kind of 2 or 3 special things that might be at least interesting for emerging economies. Well, I think we all agree, and the organization of the panel clearly shows that Pillar 2 is too big not to be split. There is no more time to speak about the general rules. Of course, we need to somehow go through the whole thing to understand how it works, particularly because in the audience, you don't need, or maybe you have no specialist in the whole globe architecture, but academics that need to add something. I recently heard someone telling me something very wise, telling me, if you have nothing to criticize, better not write anything. So if you want to go deeper, you need to split the whole thing. It's impossible now to do, unless you're a genius, kind of a very general approach to the issue. In parallel, Pillar 2 on developing countries, what I've been reading in the last 5 years was very interesting at the beginning. Now, honestly, all I read all the time is just a repetition of the 3 or 4 general arguments against Pillar 2, particularly from emerging economies. So I will not try and repeat again things that more or less everyone is familiar to, because, again, nothing new under the sun in this regard. Actually, everything that could be said in general about Pillar 2 and developing countries has been said so far, or at least I'm not so smart as to discover a new thing. So the only strategy that I had here, and I think the only strategy that we have, is try and dissect Pillar 2 in its different pieces, in its different organs, I said that, and then try to contrast this particular organ with the necessities and the very particular problems of emerging countries, which, by the way, is tricky in itself, because we talk about emerging countries, but you will see in a minute that, especially in this issue of accounting, BRICS are one thing, and the other non-BRICS emerging economies are totally different because of a technical decision made by the model rules and, of course, also by the directive. I don't need to say now that the organ that I selected, not by chance, the organ I selected, not by chance, was book tax conformity, so the relationship between accounting and tax in the world of Pillar 2. Actually, this thing that we call book tax conformity, which is very simple, at least in its canonical expression, the fact that when we compute taxable business profits, we start with the last line of our profit and loss, and then we do certain adjustments. That's what we call book tax conformity, very basically. That's not new. They've been doing that in Germany since 1870, so like 150 years, but also in other European countries, we have a huge experience with this. I think the best proof of that is that many countries have given special names to this. In Germany, it's called Maßgeblichkeitsprinzip. In Spain, we call it Principio de Determinación. In Italy, Doppio Binario. And you have different names, so when you have names for things, it's because you have the thing and you know it. If you name something, it's because you have it and you know it very well. So somehow, and last year we did the ETLP Congress essentially on this topic, we believed or we knew almost everything about that organ. So everything was familiar to us. We had been like 100 years dealing with all very small technicalities on this. But what happened here? Exactly what you see in the first line of the slides. This is a sentence that Mario Benedetti, the Uruguayan poet, attributed to himself, and then years after he recognized that he saw that written in a wall in Quito. When we believe we knew everything, all the answers, they change all the questions. And that's exactly what has happened with book tax conformity on the globe. Because if you think about the old book tax conformity, I mean, even the one you had here in Brazil, but of course, the one we have in many countries in Europe, what we had is actually a reference to the rules for the elaboration of individual accounts. And that was quite universal. And that's the way it worked. And it was a remission to local GAAP, again, for the preparation of individual accounts. However, not only the rules have changed, but also the book tax conformities. In the old world, we use accounting, just to calculate the taxable business profit. That's what I call the computational book tax conformity. Of course, we still have this under GLOBE. We use book tax conformity for the calculation of top-up taxes, but before for the calculation of the ETR, and also for the QDMTT. However, we have new book tax conformity. So on the GLOBE, we use accounting for more things than we used to use accounting in the past. We use it, and this is really relevant for the scope. Remember, you have to be over 750, and 750 doesn't come out of thin air. It's actually taking for your consolidated accounts according to your global turnover, and this comes from accounting rules. And this is crucial because this determines whether you're in or out. And that's what I call the scope book tax conformity. But additionally, we have another thing, and maybe the name here, I've thought a lot how to baptize this thing, and I came up to this factorial BTC, but if someone has a better name, I would be happy because I'm not particularly comfortable with this name. I'm here referring to some cases in which the globe rules refer to some factors, essentially payroll, tangible and intangible assets. And you might think, well, and what is the relationship to accounting? It's evident. What's a tangible and intangible asset? Which is not an evident reality, it's not a natural thing. It's extracted from accounting again, and Globe uses, again, all these accounting rules for these three factors. So we have new book tax conformities. But also, it's not just that we use accounting for more things. It's that we use new accounting rules and new accounts. Because in the past, remember, we had, if we had it, and in most countries we had it, a remission to our national, local GAAP for individual accounts. What we have now under Globe essentially is a remission to IFRS. That's the preferred accounting standard under the Globe rules. Some countries have been blessed by what I call the VAP gap. So some countries can calculate or can use for their scope, computational and factorial BTC, their domestic gap that might be different from IFRS. All countries, no. This is VAP. And which are VAP? It's pretty evident. The EU, the US, and then some more. All the BRICS came later. India was not in the beginning, but then I guess some pressure came there, and somehow Indian GAAP are also VAP GAAP, so accepted accounting principles. What happens, and this is not exceptional, this goes for around 150 countries in the world, if your national GAAP have not been blessed by the level VAP GAAP, accepted accounting principles. Well, you can also use your national GAAP for Globe purposes. However, you have to adjust it for material competitive distortion, or to avoid material competitive distortions. We will go later to this because I think that systematically it is better to deal with that a little later. And it's not just that the rules to which we make our reference have changed. It's also the accounts that we use. Because in the past, remember, we departed from the last line of our P&L for individual accounting purposes. But now, we use sometimes consolidated accounts, essentially for the scope, as I mentioned before, or we use pre-consolidated accounts. So your accounts as they are before building the whole consolidation process. And they are different, of course, because individual accounts are prepared with rules for individual accounts, and pre-consolidated accounts are prepared with gaps for consolidation. And in many countries, they are very different. I know that in Brazil, things are different because you have had kind of a massive introduction of IFRS, but this is quite exceptional in the world. I mean, this is not so common. So when we believe we had all the answers, all the questions change. What we have in front of us shares with the old big tax conformity just a name, but actually this is a totally different creature. And what I've been researching, I go here back just to see how much, oh, I've got plenty of time, it's so good. Well, no, I thought I was just running out of time. What I've been doing in the last years is saying, well, I've been working on book tax conformity, the old one, for a long time, essentially trying to research on which are the advantages of book tax conformity and which are the disadvantages in order for countries to be able to do a rational selection of conforming their computation of taxable business profits to accounting, or just going to a totally different and autonomous way and build their computation of taxable business profits totally separated from accounting, and this is a choice. And some countries in the world have it, some of them very important, by the way, even if a total separation never exists. But actually, for instance, in the US, the book says, well, we use different rules for one world and the other world. So I've been in the last years trying to say, why is that good, why is it bad? It might sound to the layman like very evident, of course, how not? Or how should we do things different than starting with accounting? It's not so easy. And in the beginning, before Belisa was very clear that we had to stick to the official title and the official framework of the panel and being on emerging economies, I was just thinking on bringing here what I've been doing in the last 2 years and saying, well, to what extent all these arguments pro and against that we have for the old world also work for the new world and the globe. I will not do that. And I will not do that because this would be equal to try to sell you something that I did for different purposes and now just put the label emerging economies that I don't like. We witness that all the time. It's very, I'd say it's very comfortable. I've got this done. If you like it, okay. If you don't like it, I don't care. I give you the same merchandise with different names. I try to think, well, to what extent all these arguments or these new rules are problematic for emerging economies. And first I started, and there is a typo there, traditional is written in Spanish, it's not written in English, it's not a C, it should be a T. Traditional arguments against book tax conformity that maybe also work for emerging economies because the problems that exist for other countries that are not emerging economies might be even more intense when it comes to developing countries applying this system. The main criticism, of course there are many, but the main criticism against book tax conformity has been that it is bad for accounting and it is bad for tax. And the reason for this, and most of the audience here, I guess, have had to deal with this if they have had to deal with accounting, and I guess all of you have, is that accounting contains a huge amount of discretion. We believe that accounting is kind of a very straightforward, linear, algebraic, mathematical exercise in which a lady or a guy with a hat is just writing the numbers on reality in a book and telling us that you sold yesterday 40 kilos of this, or you paid your employee 2,000 euros. Of course, accounting is about that, but accounting is essentially on doing prognosis. Accounting is essentially on attributing the whole income of a company to the different taxable years. And this is a total artificial exercise. And this is the reason why, if you think about accounting, if you think about what is a depreciation, what is a provision, and any other particular technicality in accounting, you will discover that you'll always have a discretion, you always have a prognosis. And of course, this leads you to a huge optionality. And if you have optionality in your accounting and your tax is linked to your profit and loss for accounting purposes, you have a huge temptation. You can just massage your accounting numbers with an eye on your taxes. And again, this is bad for both. This is bad for accounting because, of course, you will have accounts that no one will trust because everyone will know they are not down to provide information to potential investors, which is actually the main goal of accounting, but they are just done to somehow take your taxes down. And then the effect of this will be that the value of accounts will decrease dramatically. Shareholders will need to go to other documents, GAAP documents, and somehow everything will be mixed, and in the end, this would be terrible for accounting. But it will also be terrible for tax, because of course, I'm not saying that tax, and we have had the two transfer pricing panels before, I'm not saying that tax is totally free of optionality, but the level of optionality under accounting becomes or reaches a degree that I think is really intolerable for tax purposes and essentially for the principle of legality. This thing is even worse in Globe. And it is even worse because the level of discretion of IFRS is much higher than our traditional accounting rules. This has been empirically demonstrated. There is tons of work there comparing the old national GAAP with the new IFRS and demonstrating that actually the level of optionality of IFRS is huge. And it's not just that the level of optionality increase. There is something that for tax purposes is even more worrying. Because in the old world, we have pure options. Thinking about the valuation of the valuation of stock at the end of the year. You know that many countries, you can use LIFO, you can use FIFO. That's a pure option. You can do that or that. Nobody is going to do any revision. Options in IFRS do not work that way. They are not explicit options. They are implicit options. They are margins of appreciation. Think, for instance, on the capitalization of internally generated intangibles. There is not an option to expense or capitalize formulated in that way. You can do this or this, like in many traditional GAAPs. There are a lot of requirements, all very fuzzy, all very general, all in the end granting a discretion, and we don't know what the tax authorities are going to do with the control of that options. Are they going to accept whatever the taxpayer is doing, or are they going to revise that? Something that they didn't do in the past when it was just an accounting thing. But now remember, whatever you do for your accounting has an immediate effect on tax. And now I go to my point. And what does this have to do with emerging countries or emerging economies? Well, if we have learned something in the past, is that discretion in emerging economies is more worrying than it is in other countries for many reasons that I guess that you all know, but we can later discuss that in our Q&A or however we want to organize, or in the coffee or in the dinner or whatever. Now I move to the new rules. I mean, I'm now out of the general arguments pro and against. I focus on one. I am now focusing on the new rules, on the new accounting rules to which, remember, the system is doing a reference. And the question here is that all countries that have not been blessed by the label VAP GAAP, so 150 countries in the world, are forced to go to IFRS. Why is that? Remember, you can use your national GAAP for Globe purposes, but if you are not in this group of 30 selected countries, you have to do adjustments to correct material competitive distortion. And when is there material competitive distortion? If there is a deviation of more than 75 million in aggregation from IFRS. What does it mean? It means that if you are a company affected by IIR or calculating a QDMTT, and you are not using IFRS, and you are not using a blessed VAP system of accounting, you have to do the numbers with your national GAAP. And then you have to build a notional accounts. They don't exist. You have to build them on purpose to compare and then discover whether you have or not a material competitive distortion. And this is going to force all these countries, if they want not to mistreat their constituent entities or their multinationals, to move to IFRS. Is that a bad thing? Look, moving to my first point there, like 1 month ago, Professor Schoen published an article talking about the tax activism. And he was somehow denouncing that very often we find activists trying to present their work as if they were scholars. or they were scholarship or kind of technical work. I firmly believe this is the case. However, in the accounting world, this is even worse. If you go, and I've been trying with this purpose here to do this analysis in the last 20 years, you will witness that the level of technical arguments for saying that exporting IFRS for emerging countries is not a good idea is really low. Sometimes the only concern is that IFRS is an imperialist organization. It's on this level. So actually, I don't have rational arguments to say that exporting IFRS to developing countries is per se a bad idea. I don't have an opinion on that. However, I have an opinion on all those countries that do not have VAP accounts because they are losing an instrument that the other countries might have to somehow attract companies, maybe changing your residence or your headquarters because of accounting, because of BEPS. That would be too much. I don't think that any multinational would do that, but I firmly believe that many countries are thinking about somehow alleviating or somehow making the world a little easier for their multinational with the accounting rules, something that is perfectly possible. Or, if you are a country building a QDMTT, you can make life a little easier for your constituent entities by somehow changing or massaging your accounting standards. That's something that 150 countries in the world cannot do. Because if they don't move to IFRS, the only option is to maintain international GAAP, but then they have to do material competitive distortion. Whereas the others, VAP GAAP countries, can do whatever they want. Because believe me, you might think, and the OECD might tell you that US GAAP and IFRS are similar, almost identical. It's not true. It's not true. I mean, just Google differences IFRS US GAAP, and you will see the handbooks. And I'm talking here about US GAAP. Go to Europe. Compare German GAAP, they have been blessed, of course, that the EU, with IFRS. The whole thing with IFRS in Europe started because Daimler-Benz, so the German company, went to the New York Stock Exchange with their accounts, and then they said, we don't believe a word that is written there. Because, of course, this is elaborated with a totally different paradigm of accounting. And Germany can do that. And of course, Spain. I don't want to be against Germany. Any European country or any VAP GAAP blessed country can do that. The same goes for the QDMTT. Here, I think the biggest problem is whether, and I think Ricardo will insist on that later, so I will almost finish now with this. I'm almost finished. The big conundrum here is local GAAP or UPE GAAP. Of course, one and the other have advantages and disadvantages. But if you go for your local GAAP, which is not necessarily a bad idea, because otherwise you have to be applying the general accepted accounting principles of other countries. This might prove problematic for many developing countries. But if you go for your local GAAP, you find the same problems you find before. If you are blessed, it's okay. You can somehow build your QDMTT in a nice way for your constituent entities. If you are outside of the official blessed good countries with good accounting principles, a list which, by the way, has been built by the OECD with no basis, then you have no choice. Thank you.
Obrigada, professor Baez, por essa análise tão detalhada e por chamar a atenção que nossa atenção para que o Pilar 2 ele não só afeta a tributação diretamente, mas ele também está trazendo uma revolução contábil e acabando impondo com que os países, ou forçando com que os países adotem e converjam ao máximo com as normas internacionais de contabilidade, o IFRS. Bom, antes de seguirmos com com o nosso painel, eu gostaria somente de lembrar a nossa audiência para enviar as suas questões aqui através do QR Code, que aparecerá no painel, no nosso telão, entre uma apresentação e outra. Mas agora nós vamos mudar um pouquinho o tema, não totalmente, mas nós entraremos em um outro ponto crucial quando nós discutimos o Pilar 2, que é a adoção ou não do QDMTT, o Imposto Mínimo Doméstico. E eu tenho a honra de convidar o Dr. Ricardo Galendi para aprofundar sobre o tema e também para propor um safe harbor para o Brasil e para os países em desenvolvimento nesse tema. A palavra é sua, Dr. Ricardo.
Boa tarde. Boa tarde a todos. Boa tarde a todos. Eu gostaria inicialmente de agradecer aos organizadores do Congresso, professor Chueire, professor Luiz Flávio Neto, professor Rodrigo Maito, pelo convite. Gostaria também de cumprimentar os colegas de mesa, dizer que eu estou muito honrado em compor um painel com professores e especialistas tão renomados. E, bom, minha apresentação ela é sobre o QDMTT, e é um tema bastante complexo e justamente por isso a gente tem que se limitar, né? Não vou conseguir aqui expor todos os problemas e desafios que o QDMTT impõe. Nesses 15 minutos que eu tenho, eu gostaria de passar 3 mensagens. A primeira delas é que o QDMTT não é um imposto estritamente neutralizador, que é como eu estou traduzindo aqui o Soul Cup Tax. A segunda é que o QDMTT, o Safe Harbor do QDMTT, do jeito que ele está nas orientações administrativas do Inclusive Framework, ele só opera em benefício das jurisdições de origem, ou seja, das jurisdições exportadoras de capital. Ele não facilita em nada a vida da jurisdição hospedeira do investimento, né? Aqui, para não usar a dicotomia tradicional de fonte e residência, porque ela não funciona para o caso do Globo. Em terceiro lugar, é possível, sim, estabelecer um safe harbor que opere em benefício da administração tributária da jurisdição hospedeira. Então, são esses os meus 3 pontos que eu vou apresentar ao longo da apresentação e, naturalmente, vou dizer o que cada uma dessas coisas significa. Aqui eu coloquei uma estrutura de um grupo multinacional, né? Normalmente eu apresentaria uma versão mais alongada disso, explicando como a gente chega no cômputo do top-up tax, que é o imposto complementar, mas aqui suponhamos que a gente tenha feito o cálculo e computado que para a subsidiária A deve ser cobrado um top-up tax no valor de 10, para o nosso exemplo. Só queria explicar aqui como funcionam as regras de cobrança, né? Então, a gente conhece o top-down approach. Então, a jurisdição da UPE ela teria preferência para tributar esse montante. Em seguida, se a jurisdição da UPE não tivesse um IIR em vigor, a jurisdição da subsidiária 1 poderia tributar esse montante a partir de um IIR, e se nenhuma das 2 jurisdições tiver implementado o GLOBE, entram na jogada os UTPRs, que são aplicados pelas jurisdições de outras entidades do grupo multinacional. E o QDMTT, qual que é o papel dele nisso tudo? O QDMTT ele surgiu tardiamente no projeto do Globo. Então, quando a gente começou a estudar o tema, a gente sempre ouvia, olha, isso é um tema de países desenvolvidos, de países exportadores de capital, porque o Brasil não vai ter interesse em aplicar a IIR, porque a gente tem as regras de TBU. Então, não tinha muito interesse sobre o tema, só que o jogo virou quando nas Global Model Rules foram incluídas as regras sobre o QDMTT. E o que o QDMTT faz é simplesmente dizer, olha, se a jurisdição da subsidiária A cobrar esses 10, as outras jurisdições não vão ter mais o direito de cobrar o top-up tax. E, naturalmente, as autoridades brasileiras estão cogitando editar um QDMTT, porque o argumento, em suma, é que, veja, se alguém vai tributar, que sejamos nós. Esse é o argumento que subjaz ao QDMTT, e ele faz todo o sentido. Mas eu queria passar uma mensagem. Ele não é estritamente um imposto neutralizador. O que quer dizer isso? Quer dizer que para cobrar esses 10 que seriam cobráveis por um IIR, o QDMTT ele vai terminar cobrando o valor mais alto que esses 10. Tá? Então, o QDMTT ele não vai jamais simplesmente neutralizar o impacto de IIRs e UTPRs, ele vai implicar necessariamente um aumento de carga tributária em relação a um cenário que não tem QDMTT. E com essa afirmação, não tenho intenção nenhuma de dizer algo contra ou a favor, é só relatar um elemento técnico do QDMTT que eu não tenho certeza que é conhecido do grande público. E o que aconteceu com o QDMTT originalmente? Quando saíram as Global Model Rules, ficou muito claro que ele tinha duas funções. A primeira era alocativa, ou seja, vou dar à jurisdição hospedeira o direito de tributar primariamente esse montante, digamos, subtributado. E a segunda seria simplificadora. Então, nesse caso, seria muito mais fácil eu simplesmente editar um QDMTT do que eu reformar todo o meu sistema para fazer com que a entidade deixasse de ser subtributada. Então, ele tem essas duas funções, uma alocativa, outra simplificadora. Tá certo? E é importante dizer também que o QDMTT ele é um tributo horroroso.
QDMTT is something that is horrible. It keeps a third function. Oh, it doesn't have a third function. It serves only for that. So you cannot say that you have other collection purposes that would be broader than that, because it is very complex and it has not very clear economic consequences. If the purpose is much to collect more taxes, there are other measures for that, and QDMTT is not for that. Now, what is the rationale behind the policy of QDMTT? It is the following. So there is the pressure generated by tax competition and also another pressure saying that if you do not collect the tax, someone would do that. So we have the sweet spot. So we want just to tax whatever is necessary so that the other jurisdiction will not tax that or not collect something from Brazil. And therefore, with these principles related to QDMTT, we can also state that it should be a SOCAP tax, and we should also refuse any other particularity related to the use of the local gap. For example, it should be the general gap, and we should also enforce synergies based on the global information return that has been discussed now based on a template proposition of XML and so on. So, what I have said so far apply to model rules, but now, later we have the administrative guidelines, and they have simply admitted those directives. We have 4 guidelines, 4 AGs, and here I just put the dates for you to know. And altogether, we have the commentaries, guidelines, we have more than 1,000 pages, and these are the OECD style pages. So you can see that the fine print and so on, and very dense pages. The content is really very dense. It's really a lot of content. And there we can see 3 elements, and they show that QDMTT is not strictly a SOCAP tax. There is a difference in the treatment with regard to push down with regard to the CFC. So the amount to tax them according to the CFC rules is considered as a subsidiary tax, while for the QDMTT you cannot consider it as such. So this of course will increase the amount. But of course you can say that the home jurisdiction can also refer to credit, and then Brazil will only attract more tax income. I wrote a paper on this that is showing that this will not occur. This is not always true, even though in some cases this is really true. And there is an interaction with the guilty rules, which also address different or show basic differences. And the last item has to do with the charging on the jurisdictional top-up tax. So if there is a situation like this, which is a very simplified case here, so an entity has 60% of a subsidiary and the other 40% is held by people out of the group. And in my example, if we calculate a top-up tax of 100 for that subsidiary, so what happens according to the double RR is that we have to charge 60 over 100, and this is the tax that will be collected, and everyone is okay in terms of globe, right? But now the administrative guidelines say that if you want to have a qualified QDMTT, you have to charge 100. You cannot charge 60. So if Brazil edits a rule that covering 60 instead of 100, then this tax will not be considered QDMTT, but rather a DMTT treated as a covered tax, and this will reduce the capacity of the taxer to neutralize the top-up tax that can be collected in other jurisdictions. This is written in these commentaries here. You do not really have to read them. I just put this as a reference material. And then I propose some solutions. It's very easy for you to solve this problem based on changing the administrative guidelines, because we have seen in some cases some provisions have been revoked, those provisions in the AGs. Of course, they are very specific, and this one will be more significant, but there is a way for that. Now, my second topic. Well, this is a safe harbor that was proposed in the July 2023 guidelines. Basically, what the safe harbor would do is there is the home jurisdiction. So if you did a QDMTT that is not sufficiently complicated with all the characteristics that I have mentioned here, and then if you comply with some other requirements about the execution of that tax, then I can consider that the jurisdiction top-up tax will be 0. So this is the formula that is important. So it will lead us to calculate the jurisdictional top-up tax, with which in a jurisdiction that have complied with all the requirements of the safe harbor QDMTT will be 0. And how can this benefit a jurisdiction like Brazil? Nothing. Brazil would just continue to do all the math to calculate the QDMTT. So all the complexity would just push it down. So here, what initially was established is that based on the mindset of the home jurisdictions and on the developed countries will say, well, this is not for me. Now, these are the countries that will have to apply those rules, because the incentive that was created was precisely that the home jurisdictions will have to comply with the Pillar 2 rules based on the QDMTT. Otherwise, they would just be waiving the income. So you do not do this just for free. You will collect more taxes. So you do that by becoming less competitive than it would be if you didn't do anything at all. So if a country that is subject to the IIR is more competitive than the one that just adopts a QDMTT, necessarily speaking. So this is a trade-off. So it's not true that QDMTT is just a SOCAP tax. And the safe harbor, even though it simplifies for the process for the multinational group, because after all, they will not have to tax in both countries. But for Brazilian purposes, this does not really solve much. So all the complexity would have to be handled by Brazil in this case. Now the proposition is it possible for us to have a safe harbor that would effectively benefit the home jurisdiction, in this case Brazil? Can Brazil really have a safe harbor that at the same time will be safe and where QDMTT will be qualified, and then they will also streamline the Brazilian jurisdiction I believe so, because we just have to adopt a full QDMTT and comply with all the requirements according to the administrative guidelines and the commentaries on the model rules, and include a clause in the end establishing that the taxpayer will not be subject to any type of adjustment or addition if the QDMTT that is calculated is enough to neutralize RRR and TPRs around the world. So, in other words, tax administration may say, well, taxpayer, if you're not paying RRR and TPR in any other country, I will not just touch your QDMTT. I will consider that it's right. Because this is the function of QDMTT. It has to neutralize the RRR and TPR. Now, in the formula of the top jurisdictional top of tax, we just invert the logic. The home country says that I'm sure that your jurisdiction top of tax is zero. I believe that. So of course, I'm going to control and monitor that, but I'm sure of that. But you can see that effectively this country has to calculate a QDMT2 that is part of this formula. In this proposition of safe harbor, we're simply inverting the games or the elements in the game. Everything is okay, and abroad the same thing, because if you're not paying RRR and TPR abroad, this means that home countries, you look at your QDMTT, sees that you have paid it, and consider that RRR owed is zero. So I think that, we have discussed the international tax systems, whether there is a regime or not, but I think that the nature of international taxation is still basically conflictive. So we have countries that are just competing for income, and now they are competing for the allocation of tax burdens. And the way it is now, developed countries have managed to create a complex system and just have all the developing countries do that. The safe harbor of the administrative guidelines, something good for multinational groups. Groups believe that they should really claim that to be adopted in Brazil, for example. But, from the perspective of Brazilian tax law, I have doubts whether this will be good, because we do have to do all the work. So it would not be relevant for us to have taxes abroad, because the top of tax will be zero. This is a summary of the conclusions. So these are my comments. Thank you very much for your attention. Thank you very much, Dr. Ricardo, for your very clarifying talk. One of the most important things that we have been emphasizing during the panel is the impact of Pillar 2 on tax incentives adopted by countries. As Claudia has already mentioned, adopting Pillar 2 can impact tax incentives directly, and those that have been adopted by countries. And Pillar 2 will influence the use of tax incentives in the future. Given this limitation in the capacity that countries will have after Pillar 2 being adopted to offer tax incentives, there's another issue that arises. So, in the future, will these countries that today want to adopt some tax incentives affected by Pillar 2, can they adopt any other benefit that will make up for that or mitigate the effects of QDMTT or Pillar 2 itself? This is topic of the presentation delivered by Professor Gutmann. So this is something relevant, which is the prohibition of the correlated beneficials or collateral benefits. So Professor Gutmann, you have the floor.
Thank you very much. Can you hear me? Yes. Well, first of all, let me, as all have done, thank very warmly the IBDT and Professor Choueiri for his invitation. It's always a pleasure to be here. I really see this as a privilege and as a great honor. And it's always so interesting to listen to the others, as has been said earlier. I would also like to thank Belisa for coordinating our exchanges before this day, so it was very efficient and very nicely organized. More generally, by the way, the organization is just fantastic. And the last word of thanks is for the translators who do an extraordinary job, so thank you very much, especially when it comes to juggling with acronyms such as IIR, QDMTT, etc., etc. So my topic today is to provide a few reflections on the prohibition of the so-called collateral benefits in the Globe Model rules. Now, what are we talking about? As Mrs. Pimentel already explained in her introductory speech, the question or the policy choice to enact a QDMTT, so a minimum top-up tax at domestic level, is a very hard choice for developing countries generally. It's a very hard choice for policy reasons, because if you do have a system with a lot of incentives, there may be a good reason for it. And the good reason for it is that you intend to attract foreign direct investment. Now, you may be right or wrong in doing so, but that's the choice that you've made as a country. And with Pillar 2, well, basically your choice is ruined. Is ruined because either someone else is going to tax the difference between the effective tax rates of your companies on your soil and 15%, or you must tax them yourself. And if you tax them yourself, then you ruin the efficiency of your own tax system, meant as a system, as an attractive system. So it's a difficult choice for reasons that pertain to competitiveness, to the respect of tax sovereignty, and to the administrability of the system. But today, my speech is not a policy speech, and I'm not trying to assess whether Pillar 2 is a good idea or a bad idea, whether developing countries' sovereignty is fundamentally altered or not. What I'm trying to assess is the correctness of what the OECD and the inclusive framework have decided in order to assess whether a QDMTT should be qualified. In other words, whether a domestic minimum tax is qualified. And the reason why I think this question is important is because some developing countries may have legal issues with the very idea of enacting a qualified or a domestic minimum tax. They may have legal issues because they may have entered into international investment agreements that have a legally binding character for them. So if they provide, through these agreements, stability for foreign investors, if they have committed to provide a stabilized tax environment, the idea that a QDMTT is going to be enacted may actually infringe those international investment agreements or the contracts that those countries may have entered into with foreign investors. So against this background, and against the need for developing countries to keep their attractiveness more generally, there is a temptation. And the temptation is to say, okay, we're going to enact a minimum tax because that's what we have to do in order for us to keep the revenue on our territory. But we are going to provide compensatory measures. There are already examples of countries that have considered doing this. For example, Vietnam is considering enacting a minimum tax for foreign groups that have subsidiaries on the territory, but they are also considering setting up an investment fund, a public fund, which is going to support certain types of investment. And the OECD doesn't really like the idea, because the OECD is basically thinking, well, if you decide to enact a minimum tax, you shouldn't at the same time do the opposite by providing what we call collateral benefits. And you can actually find a track of this idea in the model rules themselves, because when the model rules of Pillar 2, of the GLOBE model rules, define what a domestic minimum tax is and define the conditions for a minimum tax to be qualified, what they say is a domestic minimum top-up tax is qualified if it is implemented and administered in a way that is consistent with the outcomes provided for under the GLOBE rules and the commentary, provided, and that's the essential feature, provided that such jurisdiction does not provide any benefits that are related to such rules, right? So if a company has an effective tax rate of 10% in a country, and that country decides to levy an extra 5% in order to reach the magical number of 15, well, that country should not refund those 5% by alternative and probably less transparent means. That's the prohibition of collateral benefits, which other authors call the no benefit requirement, NBR. Now, the questions that I'd like to raise today are two. First, what's the justification for this no benefit requirement? Why is the OECD requesting countries that enact domestic taxes not to provide collateral benefits? And the second question which I'd like to raise is, should we treat all collateral benefits in the same way? In other words, aren't there collateral benefits that might be more justified than others, especially in the context of countries that have to comply with international investment agreement? So let me start with a rather theoretical perspective. Why do we have a no benefit requirement? Why do we forbid collateral benefits? Well, as I said earlier, the prohibition of collateral benefits relies on a very simple idea. The idea is that you cannot act in a way and then do the opposite just the next day, This is a principle of consistency in human and state behavior. Now, this idea has a name in law, and that's called good faith. What's good faith? Good faith is honesty in the way you implement an international agreement. Good faith means that if you commit to do something, well, you cannot ruin the effectiveness of what you have committed to. And you have to comply not only with the letter of what you have agreed to, but you've also got to comply with the spirit of what you have agreed to. So it's a matter of intellectual honesty. It's a matter of effectiveness. It's a matter of preventing treaty abuse in case of a treaty, but more generally abuse of rights or abuse in a specific behavior. Now, I'm talking about good faith because I think that's the proper word to describe the reason for forbidding collateral benefits. But good faith belongs to the realm of international law. So it applies to treaties. It also applies to unilateral commitments made by states that have a binding effect upon them. And you know that in the Vienna Convention on the law of treaties, there are several legal grounds for good faith to produce legal effects. Article 26 of the Vienna Convention provides that treaties are binding upon the parties and that they should be performed in good faith. Article 31 says that treaties should be interpreted in good faith. The International Court of Justice has said that good faith is a basic principle governing the creation and performance of legal obligations, so good faith is undisputedly a cornerstone of international law. But here, GLOBE rules are not international law. The GLOBE rules are nothing else than a model. It's a model that has been established by the inclusive framework, and it's a model which is designed to be used by states for their domestic legislation. Globe rules are not a multilateral treaty. They've never intended to be converted into an international treaty. They are domestic legislation based on a model. Now, you might say, okay, but it's something more than a model. And that's the idea of a common approach. The common approach is something in between politics and law. Countries that have decided to follow the common approach of the Globe rules have done something more than just enacting a policy statement. And if you look at the definition of the common approach in the OECD, in the model rules, what it says, actually it's not in the rules themselves, but it's in the commentary of the rules. Here is the definition. A jurisdiction that joins the common approach is not required to adopt the Globe rules, but if it chooses to do so, it agrees to implement and administer them in a way that is consistent with the outcome provided under the Globe rules and the commentary on the Globe rules. So the question is whether, because we have a common approach, there is a proper justification for require states that lay down a domestic minimum top-up tax to act in good faith. And the question is indirectly whether we should apply the Vienna Convention on the Law of Treaties to an instrument such as the model Globe rules. Now, my answer to this is not easy. I believe that the model rules should be interpreted consistently with the Vienna Convention on the Law of Treaties. And the reason why I believe that interpretation should be in line with the Vienna Convention is simply because this is a collective instrument and because it's been designed by a number of countries. Now, you may, of course, question whether this is sufficiently inclusive or not, but that's not my point here. I mean, that's not the subject of my presentation. Let's say that it's an instrument which is substantively international. It's international in substance, and therefore we should seek to have a common methodology to interpret the rules. But here what we are talking about is not a problem of interpretation. What we are talking about is a problem of implementation. The question is whether we can import into the standard of assessment of the proper implementation of global rules a standard which is the good faith standard that has been designed for international law. And my point is that it's not that easy, and that it's not obvious that one should legitimately request states to behave in good faith when performing something which is not legally binding. If the Globe rules are not legally binding, if they are not a multilateral instrument, this is not by accident. This is because the countries did not want to commit to a behavior or to a set of obligations that is equivalent to those of a treaty. Now, you might say, well, it doesn't really matter, and all this discussion is purely theoretical, because nobody actually discusses the fact that Globe rules have no binding character. It's obvious. But if you look at the way the Globe rules are designed, what you see is that if a domestic minimum top-up tax doesn't qualify, well, there is a self-defense mechanism, which is a built-in mechanism in the Globe system, which is triggered, and this self-defense mechanism is no qualification. So if the minimum top-up tax is not qualified, then the risk is to raise additional tax effects in both countries. Not only the country of the host country, but also the country of the ultimate parent entity. And I'm wondering whether this self-defense mechanism is itself justified and whether it doesn't go beyond the actual intent of many countries that have decided to follow the path which has been initiated by the inclusive framework. Now, you might say, well, it doesn't really matter. This is the way the rules are now. So let's move to the next issue, which is the most fundamental one, which is how should the prohibition of collateral benefits be interpreted? And the question here is clearly, should we interpret this prohibition, or should we interpret the concept of collateral benefits in a narrow way, or should we interpret this concept in a broad way, which indirectly amounts to asking, should all collateral benefits be prohibited? Now, as an introductory statement on that, I must say that, but that's maybe excessively naive on my part, and actually I'm not sure I believe in everything I say today. That's just a parenthesis, please forget it. But, you know, I was surprised when I started thinking about this, that the inclusive framework members didn't seem to care at all about to care about the fact that some countries have binding agreements, have committed to binding agreements whereby they grant tax breaks to companies, that those international investment agreements exist and cannot be simply ignored. But when you look at the rules, there's no distinction. Whatever the reason why there is a low effective tax rate in a country, the globe system applies independently of the reason why the effective tax rate is low. And honestly, with a step back, one might have considered that there was a good case to exempt groups which enjoy the benefit of an international investment agreement from the obligation to pay a top-up tax under the income inclusion rule. So there could have been an IIR exemption in the system, but that's not there. So the result is now that because of globe rules, countries are actually encouraged to override international investment agreements if they want to enact a domestic minimum top-up tax. And this is a little bit paradoxical, right? Because, again, globe rules are not binding. So the OECD and the inclusive framework expect countries to override their international obligations, while if you conclude a treaty, well, the idea is that the treaty should be combined with other existing treaties in order for all treaties to be reconciled together. You know, this is called systemic integration, and that's in Article 31.3, paragraph C of the Vienna Convention on the Law of Treaties, that provides that a treaty must be interpreted by taking into account, together with the context, relevant rules of international law that are applicable in the relations between the parties. So there is a paradox, because here, through a common approach, countries are supposed to disregard their obligations, while they wouldn't have to do that if the globe rules had been enshrined in a treaty. So what's the outcome, and what are the options that are available for countries which have entered into international investment agreements? Well, of course, the first option is to do nothing. You know, it's to decide not to enact any minimum tax. So if you don't do that, well, of course, you comply with your international investment agreement, but you know that the revenue that would have been raised with a minimum tax, which actually will be forgone to the benefit of the country of the ultimate parent entity. So, of course, and that's the reason why on this slide I have written, UP jurisdictions say thank you, you know, because by not doing anything, the host country actually accepts the idea that the revenue will flow to the country of the ultimate parent entity. So what else can you do? Option 2. Well, there could be a case for a country to say, well, okay, I'm going to enact a minimum top-up tax, but still I have to comply with my international binding obligations. So I could decide to enact a domestic minimum top-up tax, but at the same time to provide for an exception in cases where there is an international investment agreement applicable. Of course, the question is whether this kind of QDMT or DMTT would be considered as qualified for globe purposes by the peers under the OECD/inclusive framework peer review. And probably the answer is negative. A third option would be to reach the same outcome as under option 2 by another means. And the third option would be to say, well, okay, I'm going to enact a minimum top-up tax for everybody, but I will provide compensatory benefits for groups, either all of them or for groups which are covered by an international investment agreement. And that's where the question arises whether this is a forbidden collateral benefit. As you can see, option 3 is practically equivalent to option 2, but it presents itself in a different form. So the question is whether this is really forbidden by the globe model rules. If you remember what I said when I quoted the definition of a QDMTT, the definition says that the outcome of a collateral benefit should not be the same. We should not ruin the efficiency of the globe rules. And if you look at the commentary which has been published by the OECD on the collateral benefits prohibition, what the commentary says is that the phrase related to such rules, so remember the phrase in the context a collateral benefit is incompatible with the qualified character of a tax if this benefit relates to the QDMTT, right? So the question is, what do we mean by saying that a benefit relates to the rule? And the OECD answers by saying, well, the phrase related to such rules is intentionally drafted with broad language to take into account different mechanisms through which the benefit is provided. And it also clarifies, still talking about the commentary, that the idea is not to restrict the ability of a jurisdiction to make changes to the design of its corporate tax system, as long as those changes do not result in M&E groups achieving overall tax outcomes that are inconsistent with the outcomes provided for under the globe rules. So the OECD only focuses on the outcomes, right? If you had to pay a top-up tax of 5 and you refund this top-up tax of 5, the outcome is ruined. Now, my question is, should we only look at the outcomes? And I think that in any legal system, you know, when it comes to interpreting a rule, what you're looking at is the purpose of that rule. It's the object and purpose of that rule. Now, what's the globe system designed for? Well, there are many different explanations, of course. You know, it started as a BEPS project. It was BEPS 2 or 3, I never remember. But anyway, it started as an anti-avoidance system. It was another layer to fight tax planning at the international level. And then the system progressively changed its spirit and became an anti-tax competition system. And many academics have already shown that even the tax competition excuse is not valid any longer for a number of reasons, because we have the substance, you know, the substance rule, because we have the QDMTT, et cetera, et cetera. So nobody is absolutely sure about the current objective of the system, but still, my perception is that what we are really trying to achieve with GLOBE is to prevent international multinational groups to set up companies in tax havens that have little or no substance and that are able to, escape taxation in those countries. And if that's correct, at least roughly correct, well, there's nothing wrong in a country deciding for internal tax policy reasons to maintain its attractiveness because it wants to foster its economic development. There's nothing in common, in other words, with a country that has a financial center and offers incredible tax advantage to holding companies with no substance, and a country that offers tax breaks because it believes that it's good for its genuine, authentic development. And if we have this in mind, then we should interpret the no benefit requirement differently depending on the circumstances. And what I think is a little bit subject to criticism in the way the inclusive framework sees things is that it does not distinguish between different situations. By only looking at the outcome of collateral benefits, it neglects the importance of purpose. So that was my presentation, and I'm more than happy to discuss this with you at a later stage. Thank you.
Thank you very much, Professor Goodman, for your very instigative inputs. And now I'll pass the floor to Dr. Soraya Stephens, and she will bring a practical view on the challenges faced by all Brazilian taxpayers under Pillar 2. You have the floor. Good afternoon. First of all, I would like to thank. I know that we have exceeded our time, so I'll try to be as brief as possible because I know that everyone is waiting for the Q&A session, especially for Claudia, right? My role here today is to speak about the practical aspects because at this panel I wouldn't be there bold enough to speak about scientific and academic issues. Now, as a consultant, my idea is just to raise a couple of topics that multinational groups, Brazilians or not, have been discussing according to what we have at table and what we have discussed so far with regard to challenges in the implementation of Pillar 2 in Brazil. Brazilian taxpayers, are Brazilian taxpayers ready for GLOBE? Then when we come into this topic, the first thing to address is the moment that we have been living in terms of taxes in Brazil. We start with the Brazilian tax reform that affects not only multinational groups but also taxpayers in general. And then here we start with several acronyms, CBS, SBS, and the main agenda of executives today has to do with this. So MLT, PIC, MCL, and the new legislation of transfer pricing, which is a reality, as well as tax reform that has already progressed. So based on the several discussions, so when we go to the table, we can see that Pillar 2 is still lagging behind. And then we have another factor to add, which is knowledge of the roles. So first, when we sit to talk to executives, we see that this topic is unknown to most of the executives. They do not really know their needs, what is in the scope. There are companies that are not very present in other countries. And when they plan expanding their operations, meaning increase their revenue and also go through a due diligence to see what is going on, Pillar 2 is not in their agenda. So within 2 years, then they will have to go into a Pillar 2 scope. There is the blended approach concept too. So this has to do with consolidation in Brazil. We still have the idea that we look the entity as just a standalone thing. This also has caused a lot of discussion and doubts. Then we have another thing to consider, which is collecting data. With about all the data that is necessary for you to make a diagnosis and then move on to implementation. This has to do not only about financial and accounting data or tax data, but we also have to do with operation data, factual data. So when we have to assess the substance, we have to go to the CBC, and then we have to see the head count and data that not necessarily are related to something that is easily available. And then we have lawyers and advisors that offer services in order to consolidate data and also to prepare a database so that a diagnosis or analysis can be conducted. We also have the issue of IAS 12, which has to be to do with the recognition of income or the current income tax with an exemption. So the no need of deferred information at first, but also disclosure of exemption later on. And the current income tax statement, which is also important, and the impacts, and also things that have not been completed. So the statement of the potential impact or expected impact. This tends to impact investors, and this is also another aspect for discussion. Cost is another topic, something that is very difficult for you to measure. The cost for you to train in-house people and also to work with multidisciplinary teams, and the cost of advisory services. At least at the first moment, you would need you would need the consultancy services to many groups and also control services, particularly to leverage data and control them. And lastly, we have the implementation timeline. So there are several issues related to timeline and not only related to implementation in Brazil. As Claudia said very well, we'll still have this drafted, but we have not started the process yet. As to internal deadlines for submission of the statements of group reporting, each one of them had their cutoff dates. And we also have to consider evaluation of those companies within the scope. So I try to be very brief because I know that we are behind the schedule. Thank you very much, and now I give you back the floor. Thank you very much. I would like to thank all the panelists for the excellent talks. And now I'll give the floor back to Professor Alessandro to close this session. Thank you very much. And congratulations, Belisa, for conducting this. Once again, on behalf of IBDT, thank you very much, everyone. Professor Schroeder, once again, thank you. And Professor Eric Cameron, thank you very much for assisting this panel. And thank you very much, Dr. Claudia, Dr. Andrea Braes, Professor Daniel Gutman, and Ricardo. Thank you very much for all your inputs during this panel. And now I give the floor back to our Masters of Ceremonies. Thank you.